401k plan audit may be required when the plan has more than 100 eligible participants on the first day of the plan year. If the plan hasn't been previously audited, it would need to be audited if it has 120 eligible participants on the first day of the plan year. That shifts to 100 eligible participants every year after an audit has been performed. If the plan is required to be audited, the financial statements will need to be completed and submitted with Form 5500 to the IRS 7 months after the end of the month the plan year ends. But if you file an extension, the due date for Form 5500 can be extended an additional 2.5 months. The extension would also allow the due date of the financial statements to be extended. If you have a calendar year-end plan, in other words, a plan that ends on December 31st, the audit would need to be completed by July 31st of the following year, unless it's extended, which would require it to be completed by October 15th instead. An eligible participant is anyone who meets both the statutory IRS requirements as well as the requirements of the company's 401k plan agreement as of the beginning of the year. Even if they choose not to participate in the plan, these individuals are still considered eligible. This also includes terminated employees who have balances in the plan on the first day of the planned year. The first areas the auditors will look at are documentation and compliance. They'll be conducting an analysis to make sure the plan is operating within the guidelines of plan-related documents. They'll also be taking a deeper look to make sure that the plan is in compliance with certain Department of Labor and IRS regulations. Beyond this, the auditor will review the plan financial statements, including any disclosures and Form 5500, to be sure that the financial information is being reported correctly. Auditors typically see that the plan sponsor being audited is either having plan document failures or operational errors. Plan document failure occurs when the plan document isn't designed in accordance with governmental regulations. This type of failure might happen because of an unintentional error that arose from how the plan document was originally written. It might also occur from having made amendments to the plan in response to a statutory or a regulatory change, but not having done so in a timely fashion. Plan document failures usually require the plan documents to be amended and a correction to be issued to the plan participants. However, this is only done if it's a correction that will be favorable to the plan participants. A plan operational error, on the other hand, occurs either when a transaction isn't in accordance with the plan document or the plan participant's instructions, or when the plan fails the non-discrimination test and a timely corrective action isn't taken. Some common operational errors include failure to admit participants into the plan when they become eligible, incorrect contribution amounts made to the participants' accounts, and incorrect vesting percentages being used when distributions are made. If an error is found during the audit, the error needs to be corrected within the plan and also needs to be corrected with Department of Labor and IRS. There's good news, though. The most common errors can be corrected through the IRS's Employee Plans Compliance Resolution System. The system has 3 programs that allow plan sponsors to correct plan errors. Depending on the significance and the timing of the errors, these 3 programs are the Self-Correction Program, the Voluntary Correction Program, and the Audit Closing Agreement Program. It's very important for a plan sponsor to have strong internal controls. The plan sponsor should read and fully understand the plan document, must take responsibility for the operations of the plan, and get involved with the administration of the plan. This is even very important for a company with less than 100 employees, which doesn't need a 401k audit. A lot of smaller companies feel that since they hired a third-party administrator, they aren't responsible for internal controls when it comes to the plan. This isn't the case. Companies are still held accountable for ensuring the proper internal control measures are in place. In order to familiarize themselves with their service providers, companies should obtain the SSAE 16 report. This report describes the control structure of the third-party administrator. It also outlines the controls the plan sponsor should have in place in order for the third-party administrator's controls to work properly. The bottom line is that even if you're a small plan and have less than 100 participants and you're not technically required to have a 401k audit conducted, it's still very important that your plan is operating in strict accordance with the guidelines of the plan-related documents and also that the plan is in compliance with certain Department of Labor and IRS regulations. For additional information concerning 401k audits or the IRS correction program, please contact your Untracked Early advisor today. I'm Dennis Murtha with Untracked Early.